The last few days have felt like whiplash for anyone following the market. We saw an astonishingly sharp price drop, creating this genuine fear, the kind of fear that makes you question if the whole move up was just a fluke.
That anxiety was completely understandable. I mean, especially given the speed of the drop.
Yeah.
But our mission for this deep dive is really crucial. We need to move past that emotional panic and just analyze the cold, hard market mechanics. Because what we all just saw was not a genuine crash.
Okay, so what was it?
It was a sophisticated, an orchestrated attempt to end a bull run. And the key takeaway here is that the attempt failed. And it failed spectacularly.
So we're looking at an anatomy of a failure, a moment where the paper price, the contracts and so on tried to tell a lie, but the physical market just slammed the truth back on the table. This massive, undeniable V-shaped recovery.
Exactly. And our mission today is to dissect that failure and understand what this powerful signal means for the market over the next 6 months.
This feels really significant.
It is. This is arguably the most important piece of market intelligence we've gotten in years, precisely because the attack failed. It tells you everything about the underlying strength.
Okay, let's unpack this then. We saw this terrifying drop. I mean, it was dropping several dollars an ounce in just a few hours. But then it was followed by this rapid vertical snapback. That's not normal volatility. It feels engineered. So walk us through the mechanics. What caused that selling, and why was the recovery so violent?
You're right, it's not normal. You were witnessing the successful execution of a classic textbook maneuver. It's called a bear trap. But it was immediately followed by the failure of their wider strategy. It was engineered liquidity extraction. Pure and simple.
And how does that engineering work?
Well, the big institutions, the bullion banks, they have real-time access to the order books. They know precisely where thousands of retail stop-loss orders are sitting.
Ah, they're clustered together.
They're clustered just below key psychological levels. Think just under $60 or $62. They're basically digital tripwires just waiting to be hit.
So they know exactly where the market is weakest, where the panicked selling is guaranteed.
Precisely. The strategy is to use a catalyst. It could be a scary headline, or in this case, the margin hike. They use it to push the price down just enough to hit those triggers.
And retail traders are forced out.
Automatically, they're forced to sell their positions, often without even realizing what happened until it's all over. And this panicked selling, it provides the massive volume the banks need.
They're generating liquidity by shaking out the weakest players.
That's the key distinction here. The banks are not selling to get out of their positions. They are initiating this selling pressure specifically to buy at lower prices. They need to accumulate. So they absorb every single contract sold by the panicked retail crowd and the overconfident shorts betting on a crash.
So they're filling their bags at the exact moment everyone else is running for the exit, and once they're done...
Once they've accumulated that volume, they just step away. And that's when the magic happens. Without that heavy artificial selling pressure holding the price down, the natural underlying demand just takes over immediately.
And the market snaps back?
It snaps back hard. Because the physical supply and demand imbalance is so acute, the price doesn't just crawl back, it gaps up overnight. Weak markets recover like a dead cat bounce. This was a Super Ball thrown on concrete. That vertical violence tells you everything about the strength of the current demand.
Here's where it gets really interesting for me, because they didn't just use standard selling, they used a regulatory weapon. They triggered a margin hike. Now, historically, that is the ultimate tool to kill a commodity rally. We saw it in 2011. It caused a 30% collapse. Why didn't that silver bullet work this time?
It failed because the DNA of this market has just fundamentally changed since 2011. To understand why, you have to look at who is holding the contracts today versus, a decade ago.
Okay, so let's look at the contrast.
Back in 2011, the market was dominated by highly leveraged speculators, what we call weak hands. They were just playing the price move, using maximum margin. So when the exchange raised the margin requirements, those speculators, they just couldn't wire the extra cash. They had no choice but to liquidate.
Creating that cascade of selling.
Right. But the buyers today are fundamentally different.
How so?
Entirely different. Today, the market is dominated by strong hands. We're talking major industrial users who need physical metal for solar panels. We're talking sophisticated family offices hedging against currency devaluation and even sovereign wealth funds. These people aren't gambling. They're securing supply chains and hedging their purchasing power. They have deep balance sheets.
And their response to the margin hike must have been a complete shock to the manipulators.
It was a total disaster for the bears. When the exchange raised the margin requirement, sometimes by 50%, these strong buyers didn't sell. They just picked up the phone, called their bank, and said, wire the cash. They absorbed the cost.
They just paid the entry fee instead of quitting the game.
It was the ultimate signal of conviction. I mean, they fired their biggest regulatory cannon, and instead of breaking the market, all they did was annoy the big buyers. When a market shrugs off an attack like that, it proves the buyers are completely price insensitive. The margin cost is just irrelevant to them.
That structural shift in New York sets the stage perfectly for what happened in London. London has always been the suppression capital. For decades, when New York panicked and bought, London would calmly sell and cool the market down. But this time, London suddenly pivoted. They switched from seller to panic buyer. Why? What caused that historic change?
To get that, we have to clarify the true supply situation, which is it's often misrepresented. The bears will point to the LBMA vaults and say, look, there are 800 million ounces of silver there, there's no shortage. But that 800 million ounces, that's what we call the iceberg.
The total inventory.
Correct. But the vast majority of it, maybe 85, 90% of that iceberg, is owned by ETFs, by sovereign funds, by wealthy families. It's segregated, it's vaulted, and crucially, it is not for sale at these prices.
So the inventory is locked up. What actually matters for the price then?
The only thing that matters is the float. The unallocated metal that's available for immediate sale. It's the tiny, visible tip of the iceberg. What's happened over the last 3 years is that large price-insensitive buyers, think India, think Samsung, have just relentlessly drained that float. The iceberg is still there, but the float, it's basically melted away.
Which means if a major industrial user needs a few million ounces today, the immediate supply is effectively zero.
Precisely. And when supply is zero, the price doesn't just gently rise. It has to rise violently to convince the diamond hands, the people who own the iceberg, to even think about selling. $60 won't tempt them. Maybe $100 might. This realization is what triggered the panic in London. They looked in the pot expecting to find metal to smash the price, and they found it was empty.
And this emptiness ties directly into the breakdown of the leasing machine, the dark heart of the silver trade, as it's often called. How did that system break?
The leasing market is how banks create artificial supply. They take physical silver they own, and they lease it out to industrial users, solar panel makers, for example. That user consumes the metal, turns it into a product, and just promises to return a new bar to the bank later to close the lease. It's basically an IOU system.
They're borrowing silver and paying interest.
Exactly. But here's the problem. If the industrial user, when it's time to close that lease, cannot find a new bar to buy on the open market because the float is gone, the bank has a catastrophic problem. The metal they leased out is never coming back.
That leaves a massive hole in their supposed inventory.
A huge hole. Their balance sheets are now exposed. And this is why you see lease rates spike. The market is screaming physical shortage. The banks are then forced, by their own risk managers and regulators, to frantically buy physical bars in the spot market to replace the metal they know is gone forever. This is textbook price-insensitive buying. They don't care if they pay 63 or 65. They need that metal now. And that's the London pivot we saw.
Okay, that covers the supply side beautifully. The failure of the regulatory weapon, the depletion of the physical float. Now let's talk about demand, specifically the psychological and institutional side. We're hearing about what sounds like a silent bank run on unallocated accounts.
This is a critical factor. A huge amount of big money institutions, family offices, hold silver in unallocated accounts. Think of it like money in a general bank account. You own a claim on the bank's total pool of silver, but not a specific bar. It's a fractional reserve system.
But the recent volatility, that's changed the psychology for these big players.
Absolutely. The volatility terrified them. They are now demanding conversion from unallocated claim to allocated silver. They want specific segregated bars with serial numbers stored in their own box. It's like switching your bank balance to physical cash in a safe deposit box.
And if too many large clients demand that segregation,
the bank is forced to buy the physical metal. If they were running fractional, and they almost certainly were, they have to rush into the spot market and buy the missing bars to fill those demands. This is a massive forced buying pressure that's driven by risk aversion, not speculation.
And let's not ignore that powerful engine that fuels these rallies. Regret. That V-shaped recovery is a regret machine.
Regret is maybe the most powerful fuel in any market. Just imagine the person who sold their position on Friday, thinking they were so smart. They wake up Monday and the price is significantly higher. They've lost their position, taken a loss, and the market is running away from them. They have to admit they were wrong.
And the only way back in is to buy higher.
Exactly. That desperation turns into FOMO, fear of missing out. They buy back in at higher prices, which just accelerates the rally. This bear trap successfully removed the weak believers and created the perfect psychological setup for the path of least resistance.
Which,
Practically higher.
okay, let's bring this to the immediate future. The technical battle right overhead. All these forces have converged, but there's this massive hurdle at $65. What does this all mean for where we go next?
$65 isn't just a line on a chart. It is the kill zone for the shorts. The reason is the massive open interest concentrated in call options at that strike price.
Right. For listeners, options give someone the right to buy the asset at that price, at $65.
That's right. And the banks are often the sellers of those options. If the price stays below 65, the options expire worthless. Banks collect the premium. Easy money. But if the price crosses 65, the banks are suddenly on the hook to deliver millions of ounces of silver they don't actually have.
And that triggers the famous gamma squeeze.
Precisely. As the price gets near 65, the market makers who sold those options have to protect themselves. It's called delta hedging. They have to buy a proportional amount of futures contracts to neutralize their risk. And as the price moves closer to 65, the amount they have to buy, it increases geometrically.
So their own computers force them into a self-reinforcing buying frenzy.
It creates a vacuum effect. Their buying pushes the price up, which forces them to buy even more futures to hedge. Above $65, that massive defensive wall built by the shorts, it suddenly vanishes because the defenders become forced buyers. It's the U.S. FOMO crowd versus the dollar defense team.
One final technical signal. The mining stocks, the juniors, they always seem to lag the physical metal.
This is a critical high probability signal for an astute investor. When the physical price dropped, the miners got hammered. They're leveraged to the price. But since silver recovered so violently, the miners should gap up even harder. If the metal is up 3%, but the junior silver miners ETF, SLJ, is only up 1.5%. That disconnect is a massive arbitrage opportunity. The stocks are on sale. Once equity traders realize this rally is real, that catch-up trade will be explosive.
So let's zoom out for the final perspective. The failure of that trap means 6150 is now the new floor. This feels like a huge shift in valuation. What forces, especially as we head toward the end of the year, will keep driving this higher?
The entire valuation model has shifted. 6150 is now the cheap price that billionaires rush to buy. And as we head toward December 31st, institutional behavior becomes predictable because of something called window dressing.
Explain window dressing.
Hedge funds cannot report to their clients that they missed one of the best performing assets of the year. It makes them look incompetent. So to save face, they are forced to buy the winners like silver before the year-end close.
They need to show silver on their December 31st balance sheet.
They buy winners at almost any price. It creates this powerful artificial tailwind into year-end. This institutional FOMO ties right into max pain theory. Markets often move in the direction that causes the most pain to the most established players.
And who suffers the most pain if silver rips towards 75?
The big banks who are short the paper market, the industrial sector that needs the metal, and the money managers who are underweight commodities. A run to 75 causes maximum pain for the establishment. And according to market logic, that makes it the most likely outcome.
So the core message is that the market is voting for reality over financial illusion. The wealth transfer has begun. It's flowing from digital financial assets back to real physical assets. You are living through a historic pivot point.
The volatility you just experienced will likely get worse, not better. But the structural forces, the shortage, the London pivot, the empty vaults, are all working for the long-term investor. The strategy is clear. Accumulate physical, secure the unhedged miners, and just sit tight. Let the structural forces do all the heavy lifting for you.